Alright, section 4.4. If you look in your book on page 111, you'll have this at the top here, talking about responsibility statements for merchandising business. Responsibility statements are just financial statements that report revenue, costs, direct expenses under a specific department's control. So the company, in our examples, prepares all of our usual end of fiscal period financial statements, which would be our income statement, our statement of stockholders' equity, and our balance sheet. In addition, they also prepared 2 responsibility statements, one for each department. So a departmental margin statement for audio and departmental margin statement for video. These statements they include all the information regarding gross profit, so the company doesn't need to prepare separate departmental statements of gross profit at the end of the fiscal period. Pretty much all the information that we see here laid out in front of us, we pull from the departmental margin statements audio columns of the worksheet. So for our examples here, if you flip back to page 102 and 103, that worksheet, that's where this is going to be pulled from. Okay. The departmental margin statement is going to be similar to an income statement. However, only direct expenses for the audio department are going to be included. So this form is only showing us information that has to do with audio. Okay. So notice at the top here it says it's in our audio departmental margin statement. So down here, for each account, we don't have to write the word audio again. Okay, because we know that everything in here is going to be for audio. So it saves us time and it makes it a little simpler and easier to read. So page 111 in your book is going to be something that you're going to want to flip back to as a reference point, so that you can see how this is laid out. Okay, determine net sales for department, which we remember how to do that. Sales minus discounts and returns, net sales. Determine our cost of merchandise sold, which we've done numerous times. Calculate gross profit. Record direct expenses from each department. We're pulling this all off the worksheet. And then we calculate the departmental margin at the bottom. Okay. So the main thing you know how to do these steps. The main thing you want to look back here for is where should we lay these out? What column? It's going to be a 4-column setup, and this will be a good reference point for where to add or where to subtract. Where should I put my numbers? Component percentages, just like we talked about before, are percent of net sales. So you're always going to go back to the net sales. So that's what you're going to divide these numbers by, to get all these different percentages. On page 112, it shows us our component percentages on departmental margin statements. So departmental margin divided by net sales gives us the component percentage. Okay, just telling us what we already know. We've done that before. Alright, if you flip over to page 113, you're going to see the same idea. It is the departmental margin statement for video. And again, notice it's video up here, so we don't have the word video in all these. It's the exact same steps. Just prepare 2 of them, so they give us 2 examples. Alright, next if you flip to page 114, we get into our other financial statements. Okay, so on 114 we have an example here of an income statement with departmental margin. Okay, financial statement showing revenue and expenses for a certain fiscal period is our income statement. We have done these before. They're showing us our example company's income statement for the end of the year. It's prepared with 5 columns, 2 for the departmental amounts and 3 for company amounts and component percentages. So to start with, we do the heading like we always do. Then we're going to use the information from the departmental margin statements. Okay, so we're just going to pull these numbers right off of the two departmental margin statements that we just completed. Okay, and then down here, indirect expenses. All these numbers are going to get pulled off of the income statement columns of the worksheet that we completed back on page 102, 103. Then we complete the income statement And this would be good examples here. Bring the numbers down, do a little bit of math, just like we've done income statements before. And the last thing is our calculate component percentages. Big on component percentages in this book because we have the different departments, so we have more things to compare them to. So it's more important now. At the bottom of that page, we have the steps for preparing an income statement. So you may want to summarize these a little bit and jot these in your notes, just so you have the steps down, or just reference back to this page. Either way, then go ahead and flip to page 115. Okay, on page 115, then we have a statement of stockholders' equity. Again, at the top, same heading as always. The first part, it shows, well, the stockholders' equity, the statement, it shows the change in the equity of the company over a fiscal period, okay? The two main parts are capital stock, so total shares of ownership in a corporation, or capital stock right here, and then retained earnings. So that's the amount of money that the company earned, okay, but has not yet been distributed to stockholders. So retained earnings, money we made, but we haven't done anything with it yet. Okay, the first part, the capital stock, the book's going to give us this information. They're going to tell us how much the shares are worth, how much we had at the beginning, and whether or not we issued any during the year. So issued during the current year here, we had none. Started with 340,000, we still have 340,000, okay? Now, to complete the second part, we're going to look at the balance sheet and income statement columns from the worksheet, okay? So that's where we're going to pull these numbers from. Alright, the second part then, retained earnings. This is money that the company made last year that was left in the business and not spent, okay? And we get this from retained earnings on the worksheet, and on our example, it was back on line 30. On page 102, it's on line 30, retained earnings. And then when you do your own, you just look on our worksheet, we'll pull it off of there. So that was from last year. This year then, company had net income after federal income tax of $54,956, and that comes off of line 70. Let's see here. 74, the worksheet, so down at the very bottom, how much money we made after taxes. So we're going to add the money we made this year to what we had left over from last year, minus anything that any dividends that we declared this year. Dividends then are money that the company decides to pay out to stockholders, okay? So let's back up a sec. This 155.50 was money we made last year that we did nothing with. It sat in the business. This year we made the $54,000 after taxes, and we decided as a company that we're going to pay out $30,000 in dividends. So if we subtract these two, we get the $24,000. That's the net increase, because we're going to put this much back into the business after we pay out the $30,000 to our shareholders. So from what we had last year plus what we're keeping this year gives us the $81,000. It's our balance for retained earnings. So we're going to add what our stock is worth, what stock we have, plus what we're keeping this year gives us a total stockholders' equity of $421,111. Okay. Alrighty, last but not least, we have the balance sheet on page 116. Balance sheet, nothing new here. We've done this numerous times last year. Just as a refresher, balance sheet is showing us the assets, liabilities, and owner's equity. Okay? Shows the financial condition of a business on a specific date. Okay? So whereas some of the others were for month ended or for the fiscal quarter or whatever, this one is for any specific date. Now this one happens to be the last day of the year, last day of the fiscal year, but we can do this for any particular day. Everything we need to prepare our balance sheet is going to come from the balance sheet columns of the worksheet and the statement of stockholders' equity that we just did. Alright, on our balance sheet, we're just going to plug in these numbers. Like I said, we're taking them from the balance sheet columns of the worksheet and the statement of stockholders' equity, and we're just going to plug in the numbers. What we do need to be aware of is that the total assets must equal, so total assets must equal the total of liabilities plus stockholders' equity. Okay, so the top half basically goes with the bottom half. Those need to equal when we're all said and done. If by this point these things do balance out, we plug in the numbers, they balance out, we assume that we are on the right page and everything is correct. Now let's look at the work together problem.